Hello, everyone. We appreciate you joining our November Market Update webinar today. My name is Lindsay Cook, and I'm a Senior Portfolio Manager at City National Rockdale. I'm joined by key leaders from the CNR Investment Strategy team, including CIO Charles Luke, Head of Equity Strategy Management Joseph Handelman, and Director of Fixed Income Michael Taylor. The views and estimates you hear today are sourced from our investment committee's weekly meetings. We will also discuss CNR's perspective on what's in store for the economy and financial markets and the implications for client portfolios during this webinar. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar. So please type them into your console's Q&A window anytime during this session. You can also download the presentation materials using the download window at the top of your console. I'll now turn the call over to Charles Luke of City National Rockdale.
Great, thanks a lot, Lindsay, and welcome everybody. Good to be with you today. To get started, I wanted to quickly address the elections from yesterday, from Tuesday. So they do have major implications on the political front, I think especially for the midterms next year. But the results so far have had little impact on the market, and generally many of our core views that we'll talk through today have not shifted. Now, certainly we have some news to start this morning with Challenger job cuts. So I've got a section for you on jobs, so it's good timing to talk through that. But before I get there, I wanted to go through two changes to our speedometers this month. And the first change that we made, if you look at the top of the page in the middle, is on the yield curve. So for nearly 2 years now, the curve has been inverted with short-term rates higher than long-term rates. And that's often been a warning sign of a recession. But as the Fed has lowered short-term rates and inflation has come down, that inversion has actually finally corrected. So the curve here is more normally shaped, and that's a sign that the market sees a path towards continued growth rather than contraction. And that's pretty constructive for banks, for credit markets, and for the broader economy. And so with additional Fed cuts that are likely in the coming months, combined with our view of steady long-term rates, we do think the curve could steepen further, which is a clear positive for the economy. Now, the second upgrade we've made is on energy prices at the bottom of your page. So we do understand the potential implications of geopolitical shocks, and we saw that with some of the export controls the Trump administration put on Russia just a few weeks ago. But we don't have a strong belief that it's going to create persistent, significant pressure on prices. We've got crude now trading around $60 per barrel. That's well off its lows for the year. And while OPEC has announced only a modest production increase for December, and then plans to actually pause that in the first quarter of 2026, supply does remain relatively ample. And while we'll see fluctuation in prices, we don't see a risk of persistent price pressure. Now, pressures could drift modestly higher if global activity does pick up, but that's not likely to put much pressure on consumer prices or on spending. Now, what history does show us about energy prices is they do become a real economic threat only when they rise sharply and stay high for an extended period, and that's just not the case today. So at current levels, we're going green because energy prices are helping the economy by keeping inflation pressures in check, by lowering business costs and supporting household spending. So these changes overall do continue to support our view of low recessionary risk and a slight recovery in the US economy next year. So shifting over to our forecasts, we haven't made any changes this time around for November. We have seen some consensus estimates moving closer to our views, especially on growth and inflation, while corporate profit estimates and rate views have remained relatively steady from October to November. So in terms of our view, if we take all of these expectations into account, we do see modestly higher growth for next year. And that's primarily driven by stability in corporate earnings, although we are still watching profit margins pretty closely, and Joe's going to walk you through that. We do see a decrease in the impact of tariffs, which is a positive overall for the geopolitical environment. We've seen a gradual decline in inflation, and we still have potential Federal Reserve cuts on the horizon. Now, one of the biggest issues that's happening right now is that in the absence of data, sentiment has been very poor. And my general sense is that there's more pessimism today than at any other point this year outside of March and April. But as we go into the end of the year where markets tend to do well, this might actually be a contrarian signal, especially if data starts flowing again. But a healthy dose of skepticism here I don't think is a bad thing. In 1999, we had what was called eyeball valuation, which was invented as a way to value internet companies based on the number of eyeballs on a website. Last week, Google actually made $100 billion per quarter. So We're in a very different situation today than we were in 1999. I think investors have set the bar very high for earnings, and companies have continued to deliver here. The most stunning component of third quarter earnings so far is that excluding tech, S&P 500 companies are actually growing earnings at about 11%. So that's a pretty good pace. So there's certainly a litany of risks. We do expect a pickup in volatility like we're seeing today, but we're not expecting an imminent deep pullback in the market, especially in those names that have been leading the way. But what we do see is an opportunity to take some gains and position in more of the fairly valued parts of the market to create a little more durability in the overall portfolio. So jumping right into the economy and markets and starting with the government shutdown. The government shutdown does continue with no clear end in sight here. It's now the longest in history at day 37, but the consequences are becoming more apparent to the public. So if we take a look at the current situation, arguably we believe the biggest impact from a market perspective is the absence of public data. So the sooner we can get back to normal on that front, the better. What we're also concerned about is the public safety perspective. So air traffic delays are increasing due to unpaid air traffic controllers. And with Thanksgiving holidays coming up, we think that can continue to be a major problem. And so if we think about the potential for a resolution here, despite the growing consequences, neither side at this point is taking the majority of the blame. And that's going to continue to prevent a quick resolution. We don't anticipate that Tuesday's election results will significantly alter the shutdown landscape. There was some hope that a swift resolution could come about after the elections, but at this point, that's unlikely to materialize, as both sides here do remain confident in their positions. But we do see some glimmers of hope that as the public starts to be more directly impacted, that there will be more serious bipartisan discussions. And so at this point, I think it's anyone's guess to when the impasse will actually be resolved. But the risks are skewed towards a longer resolution timeline, as they have been since the beginning of the shutdown. But I do have a sense that with Thanksgiving travel and concern around public safety, that may force a negotiation, just like it did back in 2018. But in terms of where that resolution comes from, I think given the current stance of both parties, we do anticipate that a bipartisan rank and file process will eventually lead to the resolution, rather than a clear concession from any particular leadership on either side. So shifting away a little bit from the negative and going back to last week and talking about some of the positives coming out of Trump's Asia trip. After the goods imports from China here have actually dropped to a 20-year low, you can see that on the left side, I do think that there's now reason to believe that trading could pick back up. So Trump and Xi reached a one-year trade pact that has stabilized the relationship for the time being. And most notably, I think the talks did boost optimism about a revival in agricultural trade. And China has actually removed the expansive new export tariffs on rare earths, while the U.S. has lowered those fentanyl-related levies and extended a reprieve on higher U.S. reciprocal tariffs. So positive for both sides. I do think this was a win for the Trump administration, and it does continue to paint the tariff situation as more noise with less direct market damage. What we've also been monitoring very closely have been the investment deals the administration has been striking. They now total nearly $5 trillion over the next 10 years. Now, details remain still very elusive on these, but even for the potential for a portion of these to come through bodes very well for the U.S. economy long term. And what it does do is provide another source of spending for the economy. At the same time, we're looking to shrink the deficit. So I do think that these could be impactful if the details come through and we get those investments. But overall, if we think about situations around trade and some of these other geopolitical events, we continue to believe in the potential for resolutions of these events to create this melt-up risk in the market. As investors' nerves sort of steady with the situation and we come out of the initial shock about what's happening. So we certainly can't just hope these resolutions will happen, but we do have to consider the tailwinds from these agreements and then size any allocation recommendations correctly as we do think about portfolio positioning. So shifting into the credit environment, which has been front and center on the top news page now for a couple of weeks. I don't mean to blast you with a lot of text on the individual situations, but we did want you to have that in your back pocket so you have some detail on those recent situations that have made the front page. So I'm not going to walk you through all of them, but I do want to make a few key points on credit. And then Mike's got some points as well that he'll make in the fixed income section. But the first is that not all deals are created equal. These particular deals that are being discussed are on the high end of the market. That's what's known as broadly syndicated loans, or the shortened acronym BSL. So this is why you saw large regional banks like Zions and Western Alliance get involved in these types of blowups. What these types of deals do is they lack negotiating power. They typically represent a take it or leave it type of offer. And so in a general sense, I'm not surprised to see some of these strained lending standards cause some problems. But I want to be clear that this is not representative of every single deal. So private credit is a vast market with large deals all the way down to micro investments. And so we believe that the backbone of private credit is really driven by essential companies with profit below 100 million. What that is essentially the middle market of the economy, and it's the driving force of growth. And most of these companies don't have offshore vehicles or off-balance sheet financing. In many respects, their direct lenders may be the only loan facility that they actually have. And as a rule in finance, I think I sort of go by the adage of complexity kills. So we do prefer investments in private credit and just good old-fashioned senior secured deals with seasoned managers. What I'd also like to comment on is the fact that the market is highly differentiated manager to manager, and credit underwriting can change drastically between managers. So we've had some that have seen credit cycles. We've had some that have not, especially with the growth in the private credit markets and the new entrants. But we do think that given some of the strong corporate earnings that we're seeing, that credit is doing okay. But what I am concerned about is the level of fraud at this size. So because of that, we have been focused on higher quality positions within our investment portfolios and fixed income. And our taxable high yield exposure specifically is nearly 90% invested in the highest possible rating within that market. So we do see valuations in corporate credit as pretty stretched. But despite that valuation concern, banks did see a dip in the amount of net charge-offs. So if you look at the right hand of this page, those charge-offs have actually gone down after increasing. So that's a positive signal that defaults aren't set to rise above long-term averages. So we're being very selective in our exposures to private credit. We do believe that it can be a long-term strategic part of the fixed income allocation. And we do have a tremendous amount of faith in the managers that we've selected to navigate through the downturn in credit if one were to materialize, but we're far from that at this point. So turning over to the Fed, I think with all the news swirling around this week, the Fed meeting got buried a little bit, so it was almost a non-event. But I do want to walk you through a few things that we're focused on. First, if you look at the first clip in the chart, this is a measure of Fed sentiment. And what the Fed has done is they've continued to move towards a dovish or supportive stance for the market by cutting interest rates. Powell was clear, however, in the meeting that a December rate cut was not a foregone conclusion. That was somewhat concerning to us, just given the tailwind that rates have provided to the market. If you look at the middle chart, just looking directly at the probability of an additional rate cut this year, it's dropped from nearly 100% to about 68%. So we still have some pretty good odds that we'll see a rate cut in December, but the market's not quite as confident as it was before the meeting. What I do like about this meeting is the Fed is now starting to sort of reassert itself, especially at the FOMC levels, the members that are deciding about rate policy. So we had two dissents in the meeting, which is very rare. The first is Stephen Moran, who is the Trump appointee. He preferred 2 cuts, but we also had Jeffrey Schmidt in Kansas City, the Kansas City Fed president. He voted for no cuts. And then we had the Dallas and Cleveland Fed presidents who are non-voting in 2025, but they did not support a rate cut at the October meeting. So we have some balancing out that's happening on the FOMC, which I think is very healthy for the committee and its credibility. The other component that we're watching is just the amount of disagreement that potentially is happening. It's down in that bottom clip from the levels that we saw earlier this year, and it does appear to be more unified in terms of consensus around policy. So in a nutshell, despite the concerns around independence that we were facing earlier this year, I do think that the Fed has done a really good job stabilizing itself, and I don't think anything has gotten out of hand. So the committee will be focused on a balanced approach, that's unemployment and inflation. And with some of the positive trends we have seen in inflation, we still very much believe a December rate cut is more likely than not, and that will continue to be a positive for the market. So going into labor, there's certainly been a lot of discussion around the labor market and why we've seen some job cuts out there and just the number of payroll additions decline. And we want to share the primary reasons that we think that trend has been softening. So first, if you take a look at the left-hand side of this chart, immigration has slowed. I think that's no secret, right? And it's possible that the contribution to labor force growth has actually fallen from about 90,000 at the start of the year to about 40,000 in August. And then if we look at monthly employment with industries that do rely heavily on immigrant workers, that's declined by about 30,000 jobs. So that suggests that part of these recent struggles we've seen in labor is due to a less concerning component of labor growth. Second, if we look at the right-hand side of this chart, there has been a reduction in government hiring and funding. So government hiring has subtracted about 30,000 jobs cumulatively from payroll growth this year. And then we know that federal contract spending has actually pulled back pretty sharply as well. So this does represent another known reason why the numbers are being pulled down. The third reason is what the adoption of AI technology is doing and the impact that it's having. But I don't think it's as negative for the economy overall as it appears on the surface. So I mentioned Challenger job cuts earlier on the call. They were released today, and there's a hyper focus on these numbers where there typically isn't because of the lack of public data that's available. And they're certainly widely being cited today as a reason for about the 1% pullback we're seeing in the S&P. But what that data shows specifically for technology is that technology companies do continue to lead in private sector job cuts as companies restructure amid AI integration. So if we take a look at October, about 33,000 tech jobs were lost. And for the year, the data is showing on the Challenger front about 141,000 job cuts this full year in the tech sector. So this is pretty consistent with the chart that we have here on the left side. If you look at information technology companies, they have the highest user base of AI, that's on the x-axis, and the biggest negative contribution to payrolls this year, that's on the y-axis. But we think there are a couple of reasons why this hasn't derailed the economy. The first reason is if we look at the chart on the right, it shows a massive spike in tech hiring after the pandemic, so well above trend. A portion of this pullback we're seeing today is related to a lot of overhiring that happened at that time and this gradual rebalancing back to trend. But the second component of this is what's happening with productivity. So AI is really starting to work and it's starting to filter through the economy in a much bigger way, and adoption rates are starting to soar. So the economy isn't suffering as much because of these job cuts because the revenue per employee has spiked by about 20%. And if we look at labor output per worker, it's much higher than it was just a few years ago. So in a very simple sense, productivity is increasing and there's now growing evidence to support that. So if we just consider tech companies and we take a look at the time saved by an average developer, so this is on the right-hand side, over 68% have actually reported saving over 10 hours a week using AI coding tools. So even though job cuts are higher in tech, I think the output of these workers is actually being replaced by higher productivity. Now, outside of just these direct issues, there's still lingering effects out there that are having an impact on employment, from tariff-related costs to broad macroeconomic risks and uncertainty. That's definitely still weighing on sentiment, certainly affecting hire plans, especially at small businesses. But we think this is why the Fed would be smart to continue easing rates to provide some insurance to the job market so it doesn't spill over into broader labor market weakness. So with inflation stabilizing, and we did get CPI a few weeks ago, the monthly numbers are pretty encouraging. We think that lower rates is the path to least resistance for the Fed. So shifting over to the broader market on the equity side, Joe's going to go through our current views, but I did want to talk you through some allocation decisions that we've been discussing here internally. So the first is that we have been concerned about the level of market concentration in U.S. equities. So while there's clear evidence here to support a broadening of earnings, and I talked about that, I'm very encouraged by that. If we just look at the numbers, about 10 companies in the S&P 500 have contributed about 11.9% of the S&P's return this year. And on the right-hand side here, the weight of the big 10 tech companies has now grown to about 39%. So we are big believers in the ability for AI and the follow-on ripple effect for the economy to be a game changer for growth. But we are about to finish our third year of well above average returns in the broader equity market. And so for that reason, we're looking for other areas of the market that may make sense from a valuation standpoint to offset some of this risk. And we are particularly interested in international markets. And if you listen to any of my webinars last year, what I did was I underscored the importance of growth in the picture when investing internationally. And for the first time in a long time, taking a look at this page, relative growth rates in Europe, Australia, and even Canada are set to outpace the US through the end of 2026. And specifically, if we think about Europe, it is estimated that with public and private spending, investment could be on the order of about 30% of GDP, which is massive. And so with weaker support from the US, we do believe that this could be the start of a longer-term paradigm shift, not one that leaves the US behind, but one that pulls up other developed nations. And so we do want our clients to have the ability to own these markets where they have that potential. And it's not just growth. So if we flow through to the next biggest reason why we think international could be a good idea at this point, it's valuation. So if you take a look at the sector weights on the left-hand side here in the S&P 500 versus broader global markets, you're going to see three distinct differences between sectors. The first is that global markets have about 20% less tech exposure. They have 12% more financial exposure and over 6% more industrial exposure. And if we think about financials, investors right now are in the direct path of what could be a global cycle of deregulation, and that could be a huge tailwind for the sector. So we certainly have exposure to financials in our US core portfolios, but we still remain heavily weighted towards tech given our views. So we think some of this international exposure is a natural way to balance some of that risk. And then if we think about industrials, global investors are in line for infrastructure investment and a step up in spending across developed nations. So that's another positive as well. And both of these sectors can be more defensive when we think about global downturns. And then if we go into the valuation component of this on the right-hand side, every single sector of the global market is cheaper relative to the US market. And in the aggregate, the gross difference in valuation between the indexes is at historical highs. It's almost 10 points of difference. So after a significant level of outperformance that we've seen in US markets relative to international off the April bottom, we do think that now is a good time to consider diversifying into international equities. And so our portfolio managers will be engaging with advisors and clients to determine the best way to implement this in client portfolios. And I just want to remind everybody that our DNA is to create intelligently personalized portfolios. We do believe the potential for international exposure is just another tool in the toolkit to help diversify risks and enhance the ability for our clients to meet their goals and objectives. So with that, I'll pass the webinar to Joe to discuss our views on the equity market.
Great. Thanks a lot, Charles. I appreciate that. Let's dive into equities. The equity market through the end of October is up 17.5%. That's a lot more than I thought it was going to be up back at the beginning of the year. My call was around 10 to 12%. We're up, close to twice that. We're hitting all, new time highs all the time. October 28th, we hit almost 6,900 on the S&P 500. And it's possible this is the third year in a row that we'll have double-digit equity returns. Just a phenomenal investing environment for equities. But what's the full story for the year? Through the first quarter and through April 8th, the equity market was down 15%. From that low, it rallied up 38% in just less than 6 months. That's a huge run up for the equity market. It demonstrates market resilience, strong fundamentals within companies. On the earnings side, in the first quarter, we had 13.6% earnings growth. A little bit less in the second quarter, still positive earnings growth, 10.8. Third quarter earnings are now getting reported. We're following those very closely. When the quarter started, we were around 8% earnings growth. We're now at around 13% as more companies have reported. Our thesis was that growth is slowing, the economy is slowing down, tariffs are going to sort of weigh heavily on companies. Earnings growth will slow a little bit from quarter to quarter and stay positive but decline. Actually, it's ticking back upwards. These companies appear to be very healthy. We'll dig underneath the hood and see what's going on. Going forward in 2026, earnings growth again is supposed to be in the low double-digit territory, but all incredibly healthy. And a lot of this has to do, no surprise, to the technology super cycle. Tech is up as a sector almost 29% year to date, right, versus the market, which is up around 17.5. Both tech and comm services, communication services are your big internet companies, your Googles, your Metas, and Facebooks. Also up 27%. A couple other sectors have benefited of being related to these big AI buildouts. Utilities, which produce the power for these companies. Industrials, which produce the parts and the capital goods that flow into constructing data centers. But this huge AI buildout has certainly fueled the market and has benefited these large tech companies. On top of that, we have the Fed entering a cutting cycle where it's cutting interest rates, making capital more accessible to companies, more affordable, and so the fuel that fuels the financial capital of these companies is getting cheaper and cheaper, and these companies are more easily able to access the capital it needs. Turning towards margins, What are margins? Let's just remind ourselves. Margins are the proportion of revenue that you retain, a company retains after paying all of its expenses. So you produce a bunch of widgets, you sell them, you pay your employees, you pay your electric bill, and you got a bunch of money left over. What do you do with that money? You either pay it back to shareholders in the form of dividends, or you reinvest it in your company and you grow your company. If we look at the S&P 500, the margins for the S&P 500 are around 13.5%. You can see the top right-hand chart. Margins have been drifting slowly upwards over time, meaning companies have either been getting more efficient or the environment's been better for companies to operate. This is the third consecutive quarter where we've had these higher margins in the S&P 500, and they've sort of been drifting up over time. If we compare that to technology margins, they're at almost 27%. The average S&P company is retaining about 13.5% of its revenue after paying its expenses. Technology companies almost 27%, meaning that's a lot more money that they can take and invest back into the business. Technology companies are famous for not really paying out dividends and distributing capital. They plan to do that down the line once their businesses are more mature. That's where the major growth from these companies are coming from. They're generating a whole lot of earnings and reinvesting it back into their business. Same with communication services companies, and surprisingly, financial companies as well. Big banks have had really great margins. So margins have been trending up for companies, which is good news for equity markets. Mostly pulled up by the large technology companies. What else are the technology companies pulling up? Also, the returns of the S&P 500 index. Technology is about 36% of the overall index weight. Just remember, there are 11 sectors in the index. You figured each sector will have about 1/11 of the weight, just under 10%. Not true. It's heavily skewed towards technology, which has about 36% weight in the index. The Mag 7 is up 25% plus. Technology is up almost 30%. The sector is up almost 30%. And the rest of the companies, ex-technology, are up almost half of that, 11.5%. So a major skew, again, towards technology company in the realm of returns. If we look at some more technical measures of breadth, we can look at how far companies in the S&P 500 are below their 52-week high price. The median company is more than 15% below its high price. Maybe I'll give you another metric. If I look at the S&P, returns of over the last 6 months, 70%, just over 70% of companies are below that return. Only about 30% of companies are above the return, meaning that 30% of companies is pulling up the index return, while about 70% are below. Very good stock picking environment, great for my business, but as far as market breadth goes, it's difficult. Another metric we look at is the cap-weighted index, the S&P cap-weighted index versus the equal-weighted index. The cap-weighted index weights companies which are larger more heavily. And if you look at the bottom right-hand chart, you can see a spread between the S&P 500 and the S&P 500 equal weight, which is the lighter blue line, meaning that these larger companies are outperforming the smaller companies. So again, tech is driving returns. Another thing we're going to look at is valuations. How expensive is a company? Like we said, earnings are what companies have after paying all their expenses out of their revenue. They either take those earnings and distribute them back to shareholders. How much are you going to pay for 1 unit of that company's earnings? That's what the PE ratio is. It tells you the price per share versus the earnings per share. If we look at the price per share for each earnings of the S&P going back in time, we see that it's trading at basically the 95th, 96th percentile. The top right-hand chart shows that price. We prefer to look at this ratio as opposed to just the level of the S&P 500 because we want to know how much we're paying for each unit of earnings. It's very expensive right now. It's about 26 times the price of the amount of a single earnings. That's on a 30-year average. It's around 18 times. It's now at 26 times. So that's pretty expensive. Another metric I like to look at is the value of the PE ratio relative of growth stocks to value stocks. Growth stocks are companies which take those earnings and reinvest them back into the business, like the technology companies. Value stocks tend to pay out their earnings to shareholders in the form of dividends. If we look at the spread between those two, Growth is trading at an 81% premium to value. That is also quite expensive. Technology companies are expensive relative to the rest of the market is basically what this tells us. If you look at the bottom right-hand chart, you see that line has trended up quite a bit and is now hanging out at that 80% range. That's the relative expensiveness of value versus growth companies. As we mentioned, earnings are starting to roll in for the third quarter. I'm going to talk about this for a little bit. Earnings are coming in, 13-14% earnings growth, which is higher than we thought it would be. If you look at the last couple quarters, we had 14.3% earnings growth in the fourth quarter of last year, 13.6% at the first quarter, 10.8% in the current quarter, and we figured that trend was going to continue to decline. It hasn't. It's turning around. Companies are posting incredibly healthy earnings. Surprises have come from the banking sector, which have had record investment banking fees, record trading fees from their trading desks, and also the technology companies. If we look at what percentage of companies are beating their earnings, it's about 83% right now. That's pretty high, again, compared to history. If you look at the top right-hand chart, you see that that hasn't really happened for quite a long time, not since 2001. And what makes this quarter extraordinary is the fact that analysts had raised their expectations for earnings, and we still have this incredibly high earnings beat rate. Meaning analysts had raised the bar for how hard it is to beat earnings, and we're exceeding that not only this quarter but also versus most of the historical quarters going back to 2021. So a very strong, unexpectedly strong quarter for earnings across the different companies. Let's move on. Coming back to tech, we can't escape it. They're just spending so much money across the market. In 2025, they're on track to spend over $300 billion of capital expenditures, building out data centers, building out cloud infrastructure, building out mechanisms for us to run our chat GPT models. But they're spending huge amounts of money and more than they've ever spent before. Amazon is going to spend almost $120 billion this year building out cloud infrastructure. That's 83% growth over what they've spent a year ago. If we look back 2 years ago, they actually decreased the amount they were spending. If you look at the top right-hand bar chart, that tells you the growth of CapEx spending of these different AI companies over the last year versus 2023, 2 years ago. And you can see Oracle, Meta, Amazon, Alphabet/Google, Apple have grown the amount that they're spending by an incredible amount. Google's going to spend around $85 billion, Microsoft, almost $100 billion, Meta, $65 billion, and Oracle spending as much. The surprising thing is that they have this money to spend, right? They're creating real earnings. The earnings growth in Q3 for technology companies is around 26%. For the rest of the market, it's around 10%, 9.5%. And so these companies are growing earnings. They were expected to grow earnings around 21%. They're coming in around 26% earnings growth. This is really good for these technology companies. And as AI proliferates throughout the economy, they're going through their build outs so that other sectors of the economy can take advantage of the efficiencies that brings. The point is that the concentration is justified by actual earnings. It's not just hope and dreams, right, for some of these technology companies. This is a pretty amazing time that we're going through for these different companies. So how do we position ourselves to take advantage of this? One, we are overweight the technology theme, particularly the companies that play a role in building out AI infrastructure, the chip makers, a lot of the semiconductor companies that aid with this. They have strong earnings momentum. They have strong fundamentals. They have AI integration across multiple platforms. We have to be overweight that theme. That theme, though, is very economically sensitive, and to balance out risk within the portfolio, We are also overweight consumer staples, or we're recommending an overweight to consumer staples, which is a defensive sector. Growth is slowing. Staples tend to do well in a slowing growth environment. They have pricing power as tariffs stay in are expected to stay within the economy. They're going to push out pricing to consumers. That should increase prices, and staples generally maintain pricing power doing that. We also think energy is an attractive sector. It's cheap. We think that energy prices are going to increase in a 1-year timeline. On the flip side, we're recommending underweights to financials, utilities, and industrials. Industrials are incredibly expensive. Financials, we think that as interest rates come down, that's going to hurt net interest margins within that sector. We do believe big banks are going to do well, but insurance companies, financial service companies, we believe are going to struggle relative to the other sectors. So this is generally how we're positioned. The main story is that, yes, we're buying into the AI theme, the technology theme. We believe that has more runway, but you do have to risk manage the position with an overweight to staples. And with that, I'm going to turn it over to Mike.
Great. Thank you, Joe. And hello, everybody. So I apologize. I appear to be having some technical difficulties and my camera's not working today. So if we look at the first slide here, we can see that so far it's really been an excellent year for fixed income investors. So we've seen interest rates decline across the yield curve. We've seen strong investor demand for attractive yields, resilient credit quality, and with tariffs not slowing growth to the extent that many feared, this has really helped many sectors outperform. And so, as you can see from this chart, returns are solidly positive across the board, right? Global high yield and emerging markets have been the best performers, and they've really benefited from early year weakness in the dollar. However, since bottoming in September, the US dollar has strengthened a bit here, and this has helped close some of that performance gap. But international markets are still the leaders into 2025. In the US, it's lower rates and tighter spreads that have been the primary driver for returns. And so with US Treasuries, investment grade, and high yield corporate markets, they're up about 7 to 8% this year. Within the municipal markets, investment grade munis had an excellent third quarter after lagging for much of the year, and they've really closed the performance gap in the third quarter here, while high yield continues to trail on some sector and issuer specific volatility. And then finally, if we look at the blue bars here, these represent the 1 to 10 year investment grade corporate and muni segments of the market. And these provide a good reference point where investors tend to have the greatest exposure. And so if we turn to the investment grade corporate bond market, a recurring theme that we've discussed quite a bit this year is credit quality, and that corporate fundamentals are largely positive. And we can see this on the chart on the left. And here, the light blue line shows interest coverage, or how easy it is for a company to pay interest expense. And then the dark blue line traces net leverage, or a company's overall debt burden. And so what we see is that leverage peaked during the pandemic, but has since declined as overall credit fundamentals have been stable as results of strong earnings over the last several quarters. And so companies, in effect, have maintained these manageable debt levels and are really able to meet their interest expenses, 12 times over with the money that they're making. And then on the right, we're looking at credit spreads, and that's the extra yield a corporation has to pay in order to compensate for credit risk. And here, it's a combination of strong credit quality combined with attractive yields, and this has really generated a lot of investor demand that has really outstripped supply. And as a result, this has helped push spreads to just over 70 basis points and really near historic lows. And so when we take this together, we see opportunities from strong credit fundamentals and attractive nominal yields, but we are cautious as valuations are full. And so when we look to the rest of the year, we think that total return is going to rely heavily on coupon income and the movements in the Treasury curve rather than any kind of meaningful spread tightening from here. And so the high yield or the non-investment grade sectors of the market are telling a similar story. At a very high level, fundamentals are largely positive. Defaults remain below long-term averages, and demand this year has also been strong. And so we can see in the chart on the left that spreads here in this sector are also near historic levels. But attractive yields and solid credit fundamentals aren't the only factor keeping spreads tight here. So the chart on the right shows how the high yield market has changed over the last decade. And what we see is the market has become higher in quality. So we see more double B rated and fewer lower quality triple C and below rated bonds than what we have seen in previous cycles. And the shift in quality has been another factor contributing to some of the tighter spreads that we've seen this year. And so when we put this together, we see yields over 6.5%, providing about 200 basis points of additional yield over the investment grade markets. However, we do see valuations that are tight, and this again reflects a market that is priced to perfection. And we think this leaves little room for outperformance if earnings growth were to slow or for the economy to soften a little bit here. And so on this slide, we're looking at investment grade municipals. And this year, munis have been, I think, a really interesting story with performance struggling in the first half before really reversing course in September with some very strong performance. And the chart on the left, it just plots the yield for the investment grade market. And we can see that the year started with yields around 3.6, spiked up to about 4 during that period of elevated market volatility. And then we've since drifted lower as strong demand and very attractive valuations have brought in buyers. And then on the right, we break down the credit landscape. And generally speaking, most sectors of the muni market have benefited from solid budget and operating performance over the last few years. And these gains have improved credit quality with issuers having healthy levels of reserves and balance sheet liquidity. However, as some of these gains have slowed this year, we are seeing some mixed results in sectors like healthcare and education, where federal policy and changes in demographic shifts are creating some headwinds that we think require some careful attention. But overall, despite the recent rally, valuations in the muni market look reasonable, and as a whole, the market remains sound. And then on this slide, we're looking at the high yield muni market. And as I mentioned earlier, high yield munis have underperformed while the investment grade market has rebounded nicely. And so the chart on the left here, this reflects that performance gap. And here we're looking at that difference in yield between the investment grade and the high yield markets. And we can see that as this spread tightened from pandemic era wides, this resulted in a period of high yield outperformance. More recently, as the investment grade markets have recovered a little bit here, that spread is now near a longer term average at just over 2%. And then if we look at the chart on the right, we show average default rates across the municipal bond market. And the bar on the far right, it represents the types of bonds in the high yield market. And you can see here that defaults have averaged about 1.25%. And this really compares favorably to what we see in the safer sectors of the market at just under 1%. And it's also much lower than what we would typically see in the high yield corporate markets. So in the high yield space today, we're currently seeing yields above 5.5%. And when you adjust this for taxes, that works out to a taxable equivalent yield near 9.5%. And so you combine attractive yields with above average spreads, historically low default rates, and good credit fundamentals. And we think this creates a compelling opportunity for some exposure to this asset class, especially for investors that are in higher tax brackets. So if we switch gears a little bit here, we continue to talk to clients about the benefits of moving out the yield curve, especially as as the Fed cuts rates. And when the Fed cuts rates, this means lower rates for investors who have really been enjoying those attractive money markets and T-bill yields. And now that we've had some time since that last rate hike, the first rate cut, the chart on this page illustrates how adding duration when appropriate can help improve returns. And so the yellow line here shows the annualized return for 1 to 3 month T-bills. So it's effectively a cash alternative. And then the bars show annualized returns for short, intermediate, and longer duration treasuries, corporates, and tax-adjusted munis. And so what we see is that investors who have extended maturities beyond short-term cash equivalents have achieved better total return over the past 3 years. And these returns are likely to improve as you move further out the curve. So the takeaway here is that rate cuts tend to erode cash returns, and at the same time, they're supporting longer duration fixed income. And so for investors that may not have immediate liquidity needs, with more policy, with policy rates likely to move lower over the next year here, and yields are still historically attractive, we think that maintaining or extending some duration exposure here continues to offer attractive return potential. And then finally, even though rates have moved lower on the year and have generated strong returns, we still see nominal yields as being attractive. So each pair of bars on this page shows current yields in dark blue compared with their 5-year averages in light blue. And as you can see, nearly every sector is yielding above its long-term average. And so when we think about how long-term returns tend to correlate with high starting yields, we are seeing good opportunities to continue to put money to work here, and especially when you take the muni market into consideration. And so the takeaways today, rates are broadly lower across the curve, and this is translated into solid performance. Investment grade and high yield corporate bonds are offering attractive nominal yields with tight spreads, but they do appear fairly valued. And then both investment grade and high yield muni bond performance has improved over the last several months, but valuations continue to remain attractive and credit quality resilient. So we do think adding some duration here will improve returns as the Fed continues to lower rates. So thank you, and Lindsay, back to you.
Thank you, Mike. A quick reminder that if you have a question, you can submit it in the Q&A console. I see we have a few questions already, so let's go ahead and get started. Charles, the first question is going to be for you. We've been out of international markets for a long time. What's changed in the outlook that has created the opportunity to go back in?
Great question. And we have been out of international markets for a long time. I think it's been for the better part of the past 6 or 7 years. And so our clients have benefited greatly from that call. But I walked through sort of the diversification potential with the more durable sector weights, which get you some risk reduction, get you diversified into those sectors that are a little less risky than tech. And then we talked through the historically attractive valuations that I just think at this type of level, they're extremely hard to ignore. They are historically wide, and so typically valuations are a really bad timing mechanism, but when things get stretched, we're looking for these pivot points. But one of the things that I think is the most important is that there's an increased need for spending globally now as the US steps away from having this role as this global insurer. And when you look at what's really driving some of the best performing markets this year, it's stimulus. It's where the spending is going. So if you see that spending that's picking up and that opportunity set that's improving for global developed infrastructure, I don't think you can ignore that. So I do think there is a big paradigm shift that's happening, and we want to be positioned to benefit from that. I also think as we move through the tariff situation here and we get more resolutions and it becomes a distant focus, I do think that will help global markets as well. There was a big concern that there was going to be a drag on growth, not just in the US, but also internationally. So I actually think the tariff situation is going to be a positive for other countries as they think about striking new deals with countries outside of the US and leveraging the resources that they have. So I think there's this cocktail that's sort of building and happening with respect to that international investment that, again, I don't think we can ignore. So again, we're looking for these pivot points. I do think there certainly appears to be one. I do want to be clear that we're not abandoning the US. but we do see risks from here that need to be addressed. So I don't see the opportunity set, over the past 10 years at any better level than we've seen at this point, really even until you go back to the 2008 financial crisis. So I do think this is a great opportunity for investors moving forward.
Great, thanks, Charles. And I'm going to shift to you, Joe. Are we in a tech bubble, and does this remind you of 2000? And lastly, should investors be concerned?
Yeah, who on the call asked this question? Everybody? I mean, this is the number one question that we're getting from investors, right? How can you not think about 2000? The S&P was down 37%. Tech was down 75%. Can you imagine that if tech companies just were down 75%? And today the concentration's worse, right? I mean, the top 10 stocks in the S&P are about 40% of the index. Back in 2000, it was only 27%. But no, I would say we're not in a tech bubble, and I wouldn't worry this is going to be another 2000. In 2000, companies had no earnings. I mean, Pets.com had a Super Bowl ad, and they had negative gross margins, right? And I think a Super Bowl ad was $2 million for 30 seconds back then. It's like Charles said, they had eyeball valuations back then. Today, Microsoft, Apple, Google, Amazon, Meta, these companies are printing real money. They have positive earnings. They have 20% earnings growth like we just saw. My take would be, the concentration today has gone a little bit too far. Valuations are expensive. It's justified for some of these tech companies, but I wouldn't be worried. I would just be aware, there might be a 10% correction in the market, maybe over the next couple months, but we're not going down 75% like we were in 2000. These are much healthier companies.
Okay, well, piggybacking on that question, just given how well tech has performed, why don't we just load up on all the Magnificent Seven and continue to ride the wave?
That's a great strategy. I mean, it would have worked really well the last 2 years. I mean, these aren't bad companies. Like I said, they have real earnings. The concentrations of them are pretty extreme. They're expensive. But yeah, I mean, the real answer to that is diversification, right? If you own 5 companies, then that's massive concentration risk, massive idiosyncratic risk. We do own selective mega cap companies, but you have to respect what's working, and they have been working, but you also have to build in diversification. So like I said, we own some staples in case anything goes wrong. If value begins to outperform growth or smaller companies outperform larger companies, you have to be aware of that. So tech certainly is working. We believe it's going to continue to work, but you also have to build a diversified portfolio.
Great, thank you. And going to Mike now, fixed income's done well, and you mentioned you're cautious on credit. What are you doing inside the portfolios to defend against that?
Yeah, great. Thank you. Yeah, so we have been migrating our portfolios to higher quality for quite some time. And so within our investment grade portfolios, we tend to look at blue chip household names that we think will provide good total return and an opportunity if we do see some spread compression. That said, with spreads and valuations tight right now, we have been cautious. We do have some exposure. We think maintaining some exposure within the portfolios is important for that extra yield and carry, but we are neutral versus our benchmark exposures. And then when we looked at in the high yield markets, a little bit different here. Again, though, we're seeing spreads that are tight and valuations that are high. And here we've been investing in and really migrating our portfolios into the higher quality names and sectors of the market. And so we've been underweight the riskiest segments of the high yield markets for quite some time as well. So our thought is that, stay high quality. If we see spreads move meaningfully wider and the growth story remains stable, that will give us a really good opportunity to rebalance our portfolios and take on a little bit more of that exposure.
Perfect. And I have time for, I think, 2 more questions. So I'm going to give this one to you, Charles. It's a big question from a lot of clients right now is, what would be the tipping point in the government shutdown? There has to be a market impact at some point.
Yeah, that's a tough one, Lindsay. I don't think anyone has an inside track to this. All we can do is really be at the mercy of the news flow here. But I do think they've got to get something done before Thanksgiving. I don't think that they'll allow public safety to be compromised if it already isn't compromised at this point. And I do think that as the longer this goes, and we talked about this when it started, we're going to see more volatility. And so, in that vein as well, it doesn't get talked about as much now, but Trump's scorecard is where the market is. And so, if we do get a little bit of a pullback here, and you do have a public safety concern, and there's still just a high level of fighting and even infighting between parties, then I think that's ultimately going to push them to the table. What that timeline is, I'm really not sure. But if we look through this, and I mentioned this concept earlier in the call, there's real melt-up risks with a lot of these events that are happening. So something like additional tariffs on China before the Asia trip, it was all the market could really focus on. And so there's a lot of a knee-jerk to say, we'll bring risk down if this is going to happen, only to see the market pick up a new tailwind and make a new high when there's some sort of resolution. And so I still believe that if there is a resolution, even in the short term tomorrow or even 2 weeks from now, with respect to the government shutdown, that will be a positive catalyst for the market. So we've got to balance positioning against near-term risks and risks that are likely to be resolved. But as far as timing, I think at this point, it's really anyone's guess.
Great, thank you. And the last one's for you, Mike. With the recent elections, do you have any concerns with New York City municipal credits at this point?
Oh, great! Yeah, great question. And we've actually been getting, this question a lot, and not just from our New York muni investors, but from general market muni investors as well. And so, yeah, there have been a lot of headlines. And we expect those headlines to continue at least until we know a little bit more about those policy priorities that are going to come out. And we should start to see those during the next budget cycle that's going to begin in January. But as we look at New York City credit, one of the key governance frameworks that we fall back on, it was put in place about 50 years ago, and it established guardrails that require balanced budgets and debt limits. And any changes to revenue streams, like a tax increase, for example, is going to require state approval. And so, we see these constraints as hurdles for policy setting. And while it is a little bit too soon to determine, what policy changes might mean, we do place a heavy emphasis on the state oversight and the strength of the tax base when we're doing our analysis on those credits. And so we don't expect any near-term credit impact on the city's credit rating or the ability really to pay on its bonds.
Perfect. Well, thank you to everyone for joining us. A brief survey will pop up in your console momentarily, so please share any feedback you have and suggestions for future topics. A replay of this session will be available within 24 hours, and you'll receive an email letting you know how to access it. Have a great day, everyone, and thank you.